Ladies and gentlemen, welcome back to the channel. Jerome Powell has just concluded his press conference, and we have a lot of new details to get into here in this video, so that is what we are going to do. First things first, that shook the markets up a little bit, really to the upside, and got people a little bit excited off the first couple really candles after 2 p.m. today, Eastern Standard Time, once the conference came out, was that the verbiage actually changed. In Jerome Powell's opening statement for the past year and a half now, it's always said ongoing rate hikes. They changed that to firming. That did imply, and does apply, that a pause might be coming around the corner. Obviously, Jerome Powell likes to say they're data dependent and they don't know what's going to happen, and we're going to take things by ear, and that's why data points have been so important over the last year and a half now. Now, he got asked about a soft landing, and he says the pathway still exists to a soft landing. Quote, "It's too early to say really whether these events have had much of an effect," said Powell, adding that credit standards and credit availability will be affected the longer the banking crisis continues. "I do still think that there's a pathway to a soft landing," he added, saying, "I think that pathway still exists, and we're certainly trying to find it." And that obviously moved the markets up a little bit once he did say that. But the biggest thing that really caught the market's attention, that caused the big downside during this whole conference, was this. The market is getting it wrong by predicting rate cuts this year. Quote, "In that most likely case, if that happens, participants don't see rate cuts this year," he added. And basically, it was going off the summary of economic projections. Not too much actually changed with that. Some members do see rates higher by the end of this year. So if anything, the summary of economic projections was actually bearish. Nobody sees rate cuts still by the end of this year. And Powell really confirmed this over and over again and said, yeah, we're not expecting rate cuts. Every question he got about rate cuts was the same answer, that they just don't expect that to be the case. He did go on to say in great detail about the banking crisis that they have more they can do, and depositors will be safe if banks do continue to feel the pressure. I think the biggest question in regards to the banking sector itself was a reporter, I can't even remember his name, asked if this was more so a systemic problem or just a couple bad banks. And Jerome Powell said with 100% certainty, the banking system is fine. This is not a systemic problem. This is not like '08 where everyone is involved in like subprime mortgages. This was a select few banks that had highly concentrated deposits and were underwater on their bond portfolios, right? I'm just elaborating with a little bit more detail. But long story short, Jerome Powell said it's just a couple bad banks. And Powell, again, with what I just said, Powell slammed Silicon Valley Bank management over lack of supervision, saying the bank failed badly while exposing customers to significant liquidity risk and interest rate risk. Now, Powell says committee considered a pause in light of the banking crisis. This is really due to what I said earlier, that you just don't know how big of an effect this will be. If it will be 25 basis point rate hikes, 50 basis point rate hikes, 1% rate hikes worth of tightening in credit quality and credit lending. So that's the big thing. If banks start to really not lend as much, that's where you can get more constricting on the economy. And that's the part that they don't know. Jerome Powell says there's a chance that this just goes away like nothing ever happened. And then they're back on their usual set of policy to continue to raise rates because you're not getting that offset by banks contracting lending. But if they do contract lending, then a pause might be appropriate, but they're going to have to see more concrete data on that as well as inflation. He really focused on, in the opening statement, that kind of made the market start to sell off, was price stability. over and over again. He kept saying it. He really didn't, after his segment on the banking crisis, which was the first opening statement, he really didn't go back to that. He kept reiterating, inflation is too high. We're not seeing signs. Inflation is going down. We're going to have to continue to watch data and affect monetary policy accordingly. And that is something the markets did not really want to hear. The markets have kind of been bagging on the Fed pausing or subsequently cutting rates in 2023 based off of some of these banking crises. Still, again, we don't know how bad this banking crisis will be or what effect it will have on the banking sector. And what specifically Fed Jerome Powell said about the pause was, quote, "We did consider that in the days running up to the meeting," Powell said in the press conference when asked about a pause. Quote, "We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that will bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words." Fed Jerome Powell anticipates tighter credit conditions ahead, says some additional policy firming may be appropriate. And that's really the language that changed, this firming of policy. Quote, "We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which in turn affect economic outcomes," he said. That's big. That's big. That's not necessarily a good thing. And hopefully by now you guys can see how this is really just a trade-off. It's really the same thing, but a trade-off. Either the Fed raises rates more and the banks continue lending and you're not really getting that credit crunch, or you get a credit crunch and Fed Jerome Powell doesn't raise rates as much. It's still the ultimate same outcome. And a lot of this move is trading algorithm based, so we're going to have to wait until really tomorrow to get the full effects of everything Fed Jerome Powell says, the digestion. I'm sure you guys have heard that before. But really, a Fed pause is telling you things are bad. If the markets continue to take this pause narrative and run with it. Quote, "It is too soon to determine the extent of these effects and therefore too soon to tell how monetary policy should respond." These quotes are said a little weird. Powell added, "As a result, we no longer state that we anticipate that ongoing rate hikes will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. The Fed will closely monitor incoming data and assess the actual and expected effects on tighter credit conditions on economic activity, the labor market, and inflation in order to inform its policy decisions," Powell added. He said that the Fed is strongly committed to returning inflation to its 2% objective. He said that literally over and over and over again. Fed Jerome Powell says bank deposit outflows have stabilized. The banking system is resilient and deposit flows are back on track. Quote, "Deposit flows in the banking system have stabilized over the last week." And went on to say that that is because of the policy initiatives that the FDIC, the Fed, and the Treasury have all taken together. Powell cautions that the inflation fight has a long way to go. Quote, "The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy," the central bank leader said at its post-meeting news conference. Quote, "Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high," Powell said. "Regional bank issues mean tighter credit conditions," Powell says. And this is the whole premise of getting a pause or not, is based off of this. Quote, "We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects and therefore too soon to determine how monetary policy should respond," Powell said. He later compared the banking issues to additional rate hikes, and that is kind of what we already talked about here in this video. "Fed will use all of our tools to keep banking systems safe," and again, reassured that deposits are also safe. Quote, our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound, Powell said. In addition, we are committed to learning the lessons from this episode and to work to prevent episodes from events like this from happening again, he said. Fed is having a problem pivoting, says JP Morgan. This is a note that just came out. Quote, they really should have pivoted to a much more neutral stance, Kelly said on CNBC's Power Lunch shortly after the rate increase was announced. He believes the central bank has been too aggressive in raising rates, and it is clinging onto hawkishness. In its post-meeting statement, the Fed could have acknowledged further progress against inflation, he said. Quote, unless they say they are making progress against inflation, then it is getting harder and harder for them to pivot without sounding like they are scared of the banking system, Kelly said. And that's the first quote. Again, the ongoing increases. Now, these were the biggest, essentially, things to move the markets. These are the biggest quotes to have moved the market. Now, the Fed signals one more rate increase this year, and that's basically the long story short that they're getting out of this. The dot plot sees an end of the year rate level at about 5.1%. You're at 5.75% to 5% right now. So that would be one more quarter point rate hike, and then you're going to be getting a pause. And that's going to be at the next May meeting, unless inflation were to go higher or something else were to happen. That is the median forecast. Some Fed officials did see rates going as high as 5.75 to 6%, although by the end of 2023, guys. So those are the big updates from Fed Jerome Powell. Now, how does this really affect the markets from here? As you can see, the S&P 500 is down 0.50%. And the long story short that I get out of this is that this is not good for the economy, right? If you are an investor, if you're like an honest and true investor, you're not trying to trade this market, this is not a good thing to hear, that things have gotten more difficult, right? When the Fed is talking about pausing due to a banking crisis, when inflation is 6%, that is not a good thing. That's not a good thing. And I think that's likely what the markets are starting to see here, that a lot has changed since the last Fed meeting, and not too much in the data has actually supported a big change, right? Inflation really hasn't went down. And the certain sectors that are the stickiest have not went down at all. They've actually went higher. Real estate looks to be getting even more stickier and going even higher since the last meeting. So that's really the long story short. Fundamentally speaking, this is not good where we currently sit. And even if the Fed does pause, they're pausing with 6% inflation because economic conditions are drastically worsening. Now, if the average FOMC member expects 0.4% GDP growth for 2023 to narrowly avoid a recession, they also expect the unemployment rate to continue to trend up higher, and they also expect inflation to trend down lower. The biggest things that actually moved was nothing, really. GDP, I mean, they did forecast about a 0.9% GDP gain in December. They cut that pretty much in half. So 0.4% is the average median forecast. That's it. That's all you got from Fed Jerome Powell today. As far as where the markets go from here, I think it's pretty obvious. Markets down about 1% to date. There was a lot of back and forth, kind of good and bad that came out of Fed Jerome Powell, depending on what aisle you are on, if you wanted a pivot or not. But Fed Jerome Powell said there is no rate cuts in 2023. And ultimately, if you get rate cuts in 2023, the economy is going to be in a very, very bad spot. So that's going to do it for this video. That's what you guys need to know. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section if you have not already. Thank you guys for watching, and I will see you in the next one.